Good afternoon. I'm Robyn Hall, Publishing Director of Mortgage Introducer, and welcome to our live buy-to-let webinar in association with Landbay. Unbelievably, we're now in to date 184 of lockdown. And just yesterday, the Prime Minister warned of a second national lockdown, as well as giving the order to work from home where possible. To talk about this and more, and hopefully answer some of your questions on whether the buy-to-let market is stronger than ever, or whether we are really seeing a false dawn, I'm joined today by Landbay Chief Executive John Goodall and Landbay Chairman and mortgage funding expert Tony Ward. Good afternoon to you both, and thank you for joining me. Now, again, this is a live broadcast, and we'll be taking some live questions. If you do submit a question that is not answered, the team at Mortgage Introducer will, along with both our panelists, seek to answer it privately, if not on the Mortgage Introducer website itself. But to start us off, as we know, yesterday the Prime Minister did make another sombre announcement to the House of Commons and then later on national television. So what would be the impact of the stricter rules announced yesterday on the mortgage and buy-to-let markets? John, can we start with you?
Yes, certainly. Well, obviously, it's quite a targeted easing of the freedoms that we've been granted over the last couple of months, and I think the most relevant one really is not so much the bringing forward the pub hours to 10 o'clock. That would have some impact, obviously, on the hospitality industry, and obviously that's an industry that's been challenged. And you could argue that a lot of people that work in that industry are likely to be renting. So again, it will certainly have an impact there. And then the working from home thing, which obviously that guidance has changed, and obviously the government over the course of the summer changed the guidance from work from home if you can to work from the office if you can. And then this is obviously a very clear reversal of that policy. And so what you're going to find is obviously in city centres particularly, and we've witnessed it, we're based in Victoria, that over September in particular, a lot of restaurants and pubs and cafes that had been closed even over sort of the summer had started opening up. And now that obviously, Victoria, which is predominantly offices, there's not many people that live there, they'll probably end up reversing that as they're not going to get the custom. So I think it will hit the hospitality industry pretty hard unless there's sort of government help there. And obviously that will have an impact on that part of the rental market, because those are, there'll be a lot of people who are renting who work in that industry.
Yeah.
Tony, do you have anything to add to that?
Well, I agree with that. I think in some ways it's hardly surprising. We were always told to expect a second wave, and in some ways, if you look at this globally, we're still into the first wave. It's just the effects of loosening up the restrictions as we did in the summer and across the world. And so the government's response, they're sort of in a hiding to nothing, really. If they do nothing, they'll be criticised. So one gets the feeling they're doing what they have to do, no more, no less. So it's not good news. And yes, it is a reversal of the advice that's been given to companies to get back to work. And that's caught some people out, just as a re-equipping offices. So it's not good, but it's not surprising. So we're in this for quite some time to come. So I don't think we should draw any real conclusions about something like yesterday's news is not massive in the scheme of things, really.
Certainly in the hospitality sector in London, at least anyway, a lot of the hospitality sector will live in rented accommodation. So if they suddenly can't work, there could be an issue for them paying their rents. We've got a question here from Dave Farmer from Line Consultancy. He wants to know if we're going to see an easing of the negative view of payment holidays from lenders, given so many borrowers took a holiday because they could, and the volume of those that may need assistance is likely to increase through no fault or financial ineptitude of the borrower. So do you think we'll see lenders taking a lighter view on payment holidays, perhaps?
I think it varies from lender to lender, and I think there's a different point for residential homeowners who are taking holidays and buy-to-let landlords. And I think with that in mind, when we're talking specifically about buy-to-let, there'll be some lenders that take a very clear policy, whereas if you've taken a payment holiday and you haven't paid it back, we won't lend to you. But there are others, including Landbay, that will look at the whole picture. There are a lot of borrowers that took precautionary payment holidays, who took them but they're actually back paying in full as well. So it does depend, and we, like any lender, I think we look at fundamentally, is this person that we're lending to a good credit risk? Do we think they can afford their mortgage payments under stress conditions, in fairness, because we could be going through quite stress conditions. So we're not looking at borrowers who can just scrape by their payments. We're looking for borrowers obviously who've got both a track record of paying, but also the ability to pay in under a stressed environment.
Okay, so move on. We've got a question from Kate Davies, who's Executive Director of the Intermediary Mortgage Lenders Association. Kate says, a recent survey of landlords showed that a high proportion, it's 47%, think that it will come through the current crisis relatively unscathed. Does the panel agree? And is there more granular data on whether this is predominantly the view of larger portfolio landlords? And on a similar theme, but Tony Simpson from Rosebound Financial Solutions also asks, do we know what percentage of buy-to-let owners have moved their portfolio into special purpose vehicles? Over to you, I think, John.
Well, I mean, the way, so I suppose flipping Kate's question around, is that 53% of landlords expect to come through somewhat scathed, if that makes sense. So now we're talking about unemployment doubling, but again, what it looks like, we don't know, but unemployment was at what, 4 or 5%. People are talking about 8%, 10%, etc. So in the grand scheme of things, based on that, 90% of people are going to remain in their jobs, or 85, 90%. So on that side, that's still quite a high proportion that are going to be impacted by the crisis, based on actually unemployment not getting anywhere near that levels. And as you know, the mortgage interest is still relatively cheap. And so if obviously from a landlord's perspective, if they can get access to finance and their tenants remain in work and therefore can carry on paying their rent, then landlords will be relatively unscathed. So I don't know whether that message came from larger portfolio landlords or not. Obviously, a portfolio landlord has a better spreading of risk. If you've got 20 properties, generally speaking, if 13, 14 of them are paying, you can probably cover your mortgage payments on all of them. And it will vary obviously from portfolio to portfolio, but it is a numbers game. On that second point around the percentage of buy-to-let owners who've moved, it's hard to say. We've seen over the last few years a fair bit of movement from home sort of ownership to SPVs. Obviously, by doing that, there's stamp duty and capital gains, so there'll be a lot that don't move. But in terms of new purchases, we would expect that the majority of those now would be done in SPVs. Okay.
So a question coming from John Cronin, who's a financials analyst at Goodall. I don't know if you can see the question there. He wants to know, how does the panel feel about policy evolution in a repossessions and, perhaps more importantly, an evictions context? What are landlords' current expectations in this respect? Maybe Tony, can you pass that over to you?
God, that's a good question. I think clearly government policy is, well, just back in terms of the payment holidays and payment deferrals, we've now moved away from government sort of sanctioning what we have to do, and this is in the realms of lenders have to do what's right for the borrower. So, but having said that, the guidance is clear that they're not expecting us to do repossessions of borrowers. They're not expecting us to put people out of their homes. So there's still guidance that we have to go easy on borrowers and indeed on tenants. So I can't really see that changing. The government is going to want lenders to ensure that people keep in housing, whether they're rental or borrowers. Are we going to see a change in policy? And bear in mind that much of the buy-to-let market is unregulated. If you're an unregulated lender in this sector, it's not a regulated activity. Are we going to see changes in that? I don't think we are, but we have to wait and see, I guess. So, John, do you have a view on it?
Yeah. So first on the tenant piece, I think from an evictions process, I mean, there is now a 6-month notice that's necessary. So that gives obviously some protection to tenants. At the same time, landlords are generally a sort of understanding, reasonable group. and they realise in a tough environment, if someone has been a good tenant for a number of years, and they lose their job, they're not going to necessarily throw them out straight on the street. They'll come to an arrangement, and they'll give some forbearance there. And certainly, anecdotally, that has obviously been happening over the last few months, and I'd expect that to continue. On the sort of broader piece around repossessions, and I think this again is slightly different from buy-to-let, where a lot of buy-to-let lenders, particularly specialist buy-to-let lenders like Landbay, we would typically go down a receiver route rather than the repossession route. And in that way, you're actually running the property for a while. If you can, obviously, rent it out, you will do for a period, and you're not going to a sort of quick auction sale, fire sale. You can take the time over it. So I think in the short term, we're not going to see a spike. I think lenders on the whole will not want to be in a situation where suddenly they are repossessing tens or hundreds of thousands of properties and putting them up for auction in this current market. So I think lenders will realise that we're in a situation where there should be a limited time window for this sort of economic shock. It's different to other recessions, and I think therefore lenders will take a sort of medium-term approach rather than just a quick let's evict or repossess.
Okay, moving on. A question here from Lisa, I think it's Makido from rating agency Moody's. And she asks, what changes do you see in buy-to-let renters' demand due to Brexit, Corona, other market trends? And do you think that the youngest generation will continue to be shut out of the ownership market and hence continue to support the rental demand? And she also asks if there are any trends in housing format in terms of most popular property types to rent or let out. Tony.
Sure. Well, I suppose I start by saying people still have to live somewhere, whether it's rental or owner occupied. And the buy-to-let market's now, it's getting on for 25 years old, and it's been through various cycles, and it's always held up pretty well. And I've always maintained the buy-to-let market is, to some extent, it can act as a counter-cyclical asset class to residential owner-occupied, when at times of stress, higher unemployment and economic stress, when people either can't afford to stay on their mortgage or in owner occupation, or they just can't get on the ladder, that tends to be when the private rental sector is at its strongest. So it's this counter-cyclical hedge against downturns in economies. What we also see these times of not just things like rising unemployment, which we are at the moment, but lenders tightening their risk appetite, which, as the question suggests, we then see less products aimed at higher risk sectors like first-time buyer markets, which tend to be income stretch and higher LTV. And I guess you've also got the first-time buyer market. You could have borrowers thinking, well, I could afford to get a mortgage, but now's not the time to buy. I'll rent. So for all those reasons, I think those are they give to the strength of the buy-to-let market. I think type of rental property and suitability are going to be key. Are these the right properties in the right places? And as always, I think this plays to the strength of more experienced buy-to-let landlords who've got the experience of owning, buying, renting and managing properties and selecting them in the right place for the right reasons. And those buy-to-let landlords tend to take a long-term view. And that's going to be, you're going to need that in this market, I think. Those who sort of flip in and out of the market thinking it's a way to make a fast buck is probably the last thing. I think the other thing is, at times of stress, there is financial support to tenants. It used to be through housing allowances, but we also have universal credit. So again, there's some support for tenants actually needing to live somewhere and getting financial support. Student lets and HMOs, interesting. My daughter and my son are just both students and both in HMOs, and you think coronavirus is putting them off being in those sorts of properties, but no, they're very keen to not be at home with parents, but be where the action is in those types of property. So again, it's location and type of property really. Um, sorry,
Go
yes.
on. Sorry, Tony.
The last thing is, I just repeat, buy-to-let is held up really well as an asset class. We have not, it usually outperforms in terms of 3 months plus arrears. It's generally inside the lower than the owner-occupied market, and very rarely does it go outside of it, and certainly for not material amounts. So I expect it to perform well in this market.
John,
Yeah,
do you see any? I was just going to say, John, do you see any changes in demand especially due to Brexit and coronavirus?
Not really. Now we've always been in the specialist part of the market, so we've always focused on HMOs, portfolio landlords, and the like. And there's been a trend with HMOs becoming, I think, slightly more popular over the last 2, 3, 4 years. And that's a number of reasons for that. I think it's obviously for tenants, they're more affordable, and I think particularly for people who are potentially in their 20s, they're more social than living by themselves or with their parents. And I think particularly if we are facing a lockdown, that's probably a consideration for quite a lot of people. And then for landlords as well, obviously they generally do provide a better yield as well. So they have risen in popularity. So that trend has continued. We haven't seen a huge spike there. I think in the last, one of the last sessions we had, we talked about the student market and how that potentially was potentially at risk come October. But now post the A-level algorithm U-turn, or whatever you want to call it, we now have a record number of students. So all of a sudden you can see a situation emerging where there's not enough student housing at all for all these students that have got kind of their record A-level results. So we haven't seen these big changes, and again that trend for younger for first-time buyers has been challenging for a number of reasons, and I think they've had to raise larger deposits, and that's particularly the case now where a lot of the high LTV lending has been reduced or has become more expensive. And again, as we've said before, they're also, particularly those who've been in university, they're starting their working life with considerable student debts that they're having to pay back once they hit a certain level of earnings, which is effectively an additional tax on them. So, and then finally, I think, as Tony said about the buy-to-let performing, in times of a lot of uncertainty, people will be put off making big financial commitments because they'll have insecurity about their job. And so, again, that is going to prop up demand for buy-to-let. Yes, there'll be some people who are tempted to take the plunge now because of the stamp duty cut, and no doubt will come on to that. But you take that aside, there'll be an equal number of people who actually, they're worried about their jobs, there's job insecurity, and therefore will be delaying major purchases. So buy-to-let is always going to be a sort of major part of the housing mix of the UK, is my sense. It's been resilient in the past. It serves a purpose, not for everyone, but a considerable part of the population.
Okay, I want to move on to a different question. Now, this is a question from Pascal Aholu, who says, this is about honesty. He says, I guess like everyone, we're all open for business. However, the one major frustrating issue I find at a juncture like this is honesty. Not knowing the delays being caused places us in a difficult position with our clients. And he would like assurance about the download of information and real service level agreements are provided so that we can manage the client's expectations. Right, so, John, service level agreements, where are we standing with these at the moment?
Yeah, so again, I can't talk. I mean, I think a lot of lenders are, particularly the larger lenders, are still struggling with working from home at full capacity. And we've seen a lot of, even over the last week or two, lenders quickly pull products and changing products very, very quickly if they get inundated. As far as we're concerned, we've operated traditionally on a two-day SLA in terms of turnaround. What we've actually done, and very openly, we actually pushed that SLA out to people to manage expectations to 5 days. And while we're slightly above 2 days, we're well within the 5 days. So that's the approach we've taken. We've been, we want to operate within SLA, and we've changed the metric on SLAs. Where I see additional problems that are probably outside lenders' control is, we're in a period because of the stamp duty. It's going to be increasingly busy over quarter four. but also it's not just lenders, conveyancers and valuers, and particularly if we're in a situation where valuers particularly are having trouble getting access to property because people in those properties may be quarantining or self-isolating, and likewise some valuers who might have some symptoms of COVID or cold or a headache or a temperature are then not visiting as well. So I think we will end up having quite a few bumps in the chain, if that makes sense. And not all the lenders' issues, that the valuation piece, the conveyancing piece, none of that will be running at 100%. And I think brokers and borrowers need to understand that, and particularly if they're looking, if that's where the question is, they're looking to get completions done by the end of March in line with that stamp duty, they need to allow more time than they normally would do, because it, not just from a lender's perspective, and I do agree, I think lenders should be very clear on where they're at, but there'll be bit outside of lenders' control that are likely to take more time as well.
But essentially, Landbay will always remain honest with the broker, though.
Yes, I mean, I think, and if we struggle with our service levels, we'll be open. But yes, that's always our aim, to be as honest and open as we can, and tell brokers what they can expect from us.
I think you can see with lenders, if you look at products, we got products coming to market, lenders going into products, out of products quite quickly. Some of it, you look at it where lenders are pulling what could be considered higher risk products and assume it's to do with concern more about the risks that we're seeing, or rising risks in the economy. I suspect most of it is to do with service standards, actually, that lenders are, particularly if you're on legacy systems, bigger lenders or lenders on legacy systems working from home, probably are finding it more of a struggle, if I'm honest, and that's partly driving a lot of activity switching in and out of product while they cope with trying to process it. That's my take on it.
Okay, I've got a question from Raymond DeHinzer from Robyn Financial Solutions, who also asks about rates, and he wants to know what you expect the LIBOR rate to do in the coming months: decrease, increase, or remain stable. Tony, that sounds like it's got your name written all over it.
Yeah, well, LIBOR rate expectations. Well, first of all, for better or worse, I think for worse, LIBOR's on its way out. The UK regulators have had a concerted dislike for LIBOR, and it's being replaced by SONIA. So that's going to be happening. Now, SONIA, for those of you who don't know, it's a daily index, and therefore, by definition, it's a backward-looking rate. And when you look at a period of time, you only really know what the cost of funds was during that period of time at the end of the period. Whereas with LIBOR, you set the rate for the beginning of the period. So that's a problem, and that's a problem for mortgage lenders where we might have had LIBOR tracking products in the past. So I think the first thing is you can expect lenders to ditch references to LIBOR in their products going forward, and I think most will adopt bank rate, or as people know it, base rate, or the Bank of England bank rate. So that's where that's heading. The bank rate at the moment is 0.1%. It's quite interesting to look at the Bank of England on this. There's been a lot of noise about, could we go to negative interest rates? And to be clear, the reason why central banks want to have negative interest rates is actually to do with the banking system. It's a transmission. It's a monetary policy measure, really, that allows would penalise banks for keeping their cash on deposit with the Bank of England. They'd actually charge them to keep it there. That's the effect of the negative interest rate. And so therefore, banks wouldn't want to keep excessive liquidity with the Bank of England. The whole point is it stimulates them to lend it out in the market and keep economic activity going. That's what it's about. So just to get rid of the notion that if there are negative interest rates, we can have negative interest rate mortgages. That just simply isn't going to happen. But interestingly, yesterday, much as we've had a lot of noise about negative rates, I saw Andrew Bailey doing a cast from the Bank of England saying, well, it's one of the weapons in their armory. They need to know that it's a viable option, but they got no plans to implement it at the moment. And so what they're doing is testing the system, because he wants to know that if it is an option, could they implement it? Could technologically the banks and the Bank of England implement it? And it is not without its difficulties, I would say. So he's signalling no plans at the moment. What do I think is going to happen to bank rate? Nothing. I think it's going to sit where it is for the foreseeable future. I mean, remember the Bank of England Monetary Policy Committee are targeted with focusing on inflation of 2%. And if it varies from that 2% target by 1%, they have to write to the government and explain why and what they're doing about it. Well, it's down at about 0.8 or something at the moment. We're way below, or even down. Yeah, down. No, I think it's down as low as 0.2. So inflation is irrelevant right now. Bank of England are failing to hit their targets. They certainly will not be putting up interest rates. That's not in their favor. They need some economic activity. And it's also at a time when oil prices have fallen significantly as well. We're down to sub $40 a barrel from over $60 a barrel when COVID-19 started. So rates aren't going anywhere for the foreseeable future, would be my view.
Now, we had some questions from Scott Ailiff from Streets Ahead about negative interest rates, and I think you've covered most of those. One of the other questions Scott had, though, was do you think mortgage rates and terms could follow some of the parts of the world where the term can be up to 100 years and then the family inherit the debt asset? Can you see a 100-year mortgage ever happening?
Yes, in theory. I mean, this is something that the industry has talked about for a long time now, which is transgenerational lending effectively, and you pass on the debt through the family. Do I see the innovation in the mortgage industry to adopt that? Certainly over the near term. I just don't really, if I'm honest. I think we're too busy dealing with the here and now. So I wouldn't rule it out, but I can't see that being a major part of our mortgage industry in the near term.
Yeah, John, do you have any thoughts on that?
Yeah, I mean, I think people have talked, quite a few times about, longer term fixed rate mortgages, 7-year, 10-year terms. There are products every now and then that come out that are 7-year, 10-year terms, and they typically quietly disappear. Again, I think over the last few years, some of it's because of the affordability calculations. I think some of it's also, as we were talking earlier, about sort of long-term, what's happening to long-term rates, that people want to lock them in. And, going on from what Tony said, 5-year swaps right now are 0.2%, where, so the market doesn't expect them to be much higher than where they are today. And so there's obviously a reason to lock those in. But generally speaking, those products, the longer term products beyond 5 years, even though they've been out there, they generally haven't had, forget the issues around funding them, there generally hasn't been that much demand generally.
Okay. Now we've got a couple of questions regarding tax, everyone's favourite subject. We have a question here from Ian Hall, no relation, I can assure you, who's concerned that we'll see the government go for landlords to recoup some taxes over the next few years. He says, I think that will hit individuals and limited companies personally. However, can they really tax limited companies which own properties and treat them differently to a normal limited company that offsets debt interest? John?
Yeah, actually, I just got a message from one of my colleagues. Japan actually also has 50-year mortgages for multi-generation. So I just got sort of texted that while I talk. So obviously there is demand in other parts of the world. Look, I think, on tax, once we get through this crisis, tax is going to go up. I mean, let's face it. And whether that be income tax, whether it be capital gain tax, whether it be pension relief, whether it be stamp duty, the government is going to have to recoup some of what they spend. I do believe that actually some of it can be, with interest rates where they are, some of it can be, we can afford to increase borrowing somewhat, but at the same time, they can't just sit there and do nothing as well. So in terms of equalising, so landlords and, properties held in a limited company versus direct name, it's very, very complicated to do from a government point of view in terms of the legislature. It would have a massive impact on, for example, companies like British Land, but other companies that actually are highly leveraged and own property. It would have a huge impact and would be going against the rest of the world. So listed companies would have a huge problem. So I think it's very, very difficult for the government to do that. There may be ways, but I think the government will be looking for relatively simple ways they can do it that also that are also effective at raising money without causing problems for businesses.
Okay, I've got a question here from Tony Gimple. Tony wants to know, what does the panel feel about mortgage brokers who may be unwittingly be giving tax advice when talking about buying investment properties via a limited company and thus finding themselves outside of their scope of authority and perhaps their FCA network authorization, leading to a possible breach of their PI cover? Also, could that lead to another mis-selling scandal? Now, this is a complicated issue. John, what's your view on this?
I think, we're at a point where I don't think mortgage brokers should be advising on tax, and I think they have to tread the line carefully. I think a lot of mortgage brokers we know will often present both if it's a purchase, say, look, this is the options for a limited company in terms of the mortgage you get, and if you were to buy it in your own name, these are the options you could do in your own name and the mortgage you could get. But they would typically, certainly the brokers we know, would then say, go and speak to an accountant, a tax advisor, to better understand this. Whether it's a mis-selling in the same way as some of the ones we've had in the past, I'm not sure necessarily. It could be classed as that. I don't know. But again, I would advise them not to, because I think that I agree it could be in breach of obviously their permissions, and they're sort of treading a potentially dangerous line, not through any misintent and not necessarily for their own benefit. So bear in mind they probably are trying to act in the customer's best interest. It's not necessarily they're getting paid more to promote a certain route, but unwittingly, yeah, you're right. They could end up getting caught out.
They could, and you mentioned PI cover there as well. I have another question from Stuart at liquidexpatmortgages.com. And he wants to know, what is the FCA, IMA, IMLA specifically doing to date to ensure basic market choice availability of PII cover being available for mortgage brokers? That's from M. Stewart. PII cover is a bit of an issue.
Yeah.
Tony, have you got any thoughts on this?
It is an issue, and it's not just for mortgage brokers. It's across the line. I mean, we've had one very large PI insurer pulled out the market. In fact, I think I'm right in saying there's something like only 6 PI insurers currently providing cover. So this affects brokers, lenders, regulated entities, surveyors, valuers. It is an issue, and I've certainly heard of PI insurers with firms who have never had a claim from that firm, have provided PI for many years, just refusing cover or ramping up the rates to uneconomic levels. So I've looked at this in relation to the surveying and valuation markets, where I know it's of great concern. It's just yet another thing that the valuation market's having to deal with. What's being done about it? I'm not really sure that regulators or trade bodies, what can they do about it? Unfortunately, I think in the surveying market, in any event, there are lots of other things going on there as well. Aging population and surveyors, more use of technology and so on. So I'm predicting that there's going to be less hard valuations done in that sector. So, but someone's still going to need to take out PI cover or some form of insurance, but maybe it's not PI in the future around that. I don't know. John, do you know anything from an IMLA perspective? I'm not aware.
No, I'm afraid on that one. No, nothing I can really add, I'm afraid.
Okay, interesting. Sticking with tax, I'm going back to stamp duties. Ivan Cox from the Money Hub. He wants to know if you think there's a chance that HMRC may well drop the 3% additional levy on stamp duty in the future if property market drops in the new year. John, you were touching on stamp duty earlier.
So I think it's worth remembering that before the election, I think it was even a manifesto in the Conservative manifesto. One of the things that the Conservative government said they'd do was to look at stamp duty and potentially reform it. Obviously, that election seems a long time ago, and we're in a very different place than we were in December. But do I think so there is obviously potential once we're through this that there is a broader reform of the stamp duty tax. I think in terms of short term, dropping that additional 3% levy on buy-to-let landlords, if that's what the question means, I think it's unlikely, to be honest. I think for politically, I think the government to turn around and say, actually, we're going to reverse this tax on landlords, it will be viewed as a tax cut for landlords, which I think politically doesn't probably sit well right now. So I can't see that changing. I think it is possible that the current holiday on the other 3%, the standard 3% that's come off until end of March, I think it's certainly possible that that period is extended somewhat in order to keep the property market ticking over. I'm not saying it's probable or anything, but I think it's something that I hear is being mooted, and I think they'll probably review at some point. But I can't see landlords getting that 3% levy reversed.
Yeah, I've been hearing some rumours about preventing a cliff edge. So maybe with that stamp duty, it would be extended, but gradually extended.
We've got experience, haven't we? We've done this sort of thing before with things like those of us who remember when Miras was phased out, and it was announced that it was going to go. And so you had an absolute boom in the mortgage and housing market, while everyone was trying to get in before the benefit fell away. Similar sort of thing with stamp duty. The government have unwittingly, or maybe wittingly, have created a bit of a feeding frenzy with, well, they were trying to do it, weren't they? They were trying to keep housing transactions up, but because it has a cliff edge, it sort of artificially, it causes a problem when it causes a problem right up to the wire with people trying to close transactions, impacts on SLAs, liquidity, all sorts of things, and then suddenly the market stops. So it might be good if they phased it out rather than just stop this. Maybe that's an alternative, perhaps.
Oh, we can wait and see. Got a question here from Gavin Scott at Money Doctor Financial Planning. And he wants to know, does the panel see any increase in the appetite from lenders to cater for the increasing demand from older borrowers, say 60 to 65 plus, and also so-called professional landlords, such as those with five or more buy-to-let properties? John, what's happening in this sector?
Well, again, I'll certainly speak from buy-to-let, but the answer is yes. I mean, that's really what specialist lenders do, particularly on the latter point, for professional landlords who have 5 or more properties, or 4 or more is typically the Bank of England criteria or guidelines. But that's really what the entire specialist buy-to-let market caters for, not just single numbers, 8 properties, but 10, 20, etc., etc. So that there is quite a lot of quite a few lenders operating that space. I think it's a space where the larger lenders, I think, are unlikely to move into it. Does mean a lot more underwriting. We'll see that they could move into it at some point. And again, within buy-to-let, within that space, again, I think we're quite well set up for older borrowers. Most lenders look at the age at the end of the term. So if someone is 60, for example, the lender may have a 85 or 90 at the end of term. So that person at 60 may not be able to get a 30-year mortgage term. They may be able to get a 20 or 25, but they'll be very comfortable lending. Certainly, I'm talking for Landbay, for people in their late 60s, 70s. It just might mean that we may not be able to offer the full 30-year term that we can for younger borrowers, and I think it's a fairly typical approach in our space.
Okay, I want to move on to AVMs. Tony, this is a nice little subject for you. We've got Damien Grafton of JLM Mortgage Services asks whether, in the current climate, Landbay will be switching to AVMs. We obviously had all those problems back in March with lenders not being able to, or valuers not being able to go out. So with more restrictions in place, is this something that Landbay will perhaps consider? Also, I've got here Charles Alexander of HCF, and he says he's had 3 AVMs for clients and says the average result is a 15% down valuation when the values put on these remortgage applications were realistic. Why are the values being so negative on values when there is no evidence of a major drop in house prices as yet? I understand that the current climate does not look very optimistic, but it is fair. But is it fair to forward value a downturn in the market when nobody knows the outcome? Tony, AVMs.
Yeah, well, a few things there. Well, first thing is the the AVMs with a 15% down value, if it's just off the AVM, it's the AVM doing that, surely not the valuer. But just on AVMs, I think AVMs are great and they have their place, but for lending above sort of fairly modest LTVs and standard construction properties on their own, I'm not a fan of them on their own. I think they're a very useful tool as part of a risk management tool. So AVMs, let's not forget, are backward looking. It's a bit like Sonia, actually. They gather data on real transactions. And so, as I've said before, when we were in COVID-19 early lockdown and there were no transactions, there's a big gap in the database for AVMs. So that's not so good. The other thing AVMs are not so good at is predicting cliff edges. So if you were looking at November onwards, when furlough schemes and payment deferrals and stuff falls away and the nights are drawing in and it's getting dark and a bit miserable out there, and pubs are shut at 8 o'clock or whatever it happens to be, if you think that's going to have a more significant impact on the economy and the housing market, if you did, the AVM won't be seeing that. So, so I like AVMs as part of a broader range of risk management. So there are much more sophisticated tools out there now, which lenders and valuers use, which incorporate AVMs, but they gather lots of other data as well. And I am a fan of that because I think that is the direction for probably the majority of lending and risk management of the property value, the way it's going, but not AVMs on their own. Rating agencies and regulators, for that matter, probably a bit of a problem with AVMs on their own as well, if you're using it to value properties in a securitization. So I think you need to be able to demonstrate that you have taken into account really a number of factors, not just historical data of a black box algorithm valuation driven out of historical data. You need to have something a bit more than that. You can convince yourself, regulators and rating agencies, is coming out with a proper number with proper comparables and so on.
So, John, just to clarify then, in terms of Landbay's position on AVMs in the current climate, that's not something you're perhaps looking at yet.
Well, so in the it's something like probably all lenders did. We looked at it in lockdown, and to be clear, there's AVMs, which is basically just a data, and there's desktop valuations, which is a valuer sitting down and looking at comparables and maybe using AVM as well. So we looked at desktop valuations, not just out and out AVMs. There is a difference as well. So we looked at desktop solutions. We made some headway on it, but actually the lockdown eased, and obviously then values could go back to work, et cetera, et cetera. It's something we'll continue on looking at. We haven't found the right solution for us and our funders yet. There are problems with securitization. It's not impossible, but there are complications. So it's not ruled out. We don't accept now. We use physical valuations, and I expect that will be the case for the certainly for the short term. But it's something that we'll still continue to try and look at as well.
Okay, we've had a couple of questions come in on the actual markets themselves. Luca Bertolino from Your Mortgage Experts wants to know, says there has been some talk about a property price crash. There's this old chestnut. What do you think will be the impact, and how will lenders like you, relying on capital markets, work through the storm? Meanwhile, I've got Greg Cunnington from Alexander Hall, who asks, how will the market for securitization for mortgages look in the coming weeks and months? And Harpreet Chadha from Noble Life says, many specialists are funded by institutional investors. Do you feel that this source of funds may dry up as investors go running scared of the property market? Property price crash, Tony?
Well, yeah, well, it's really difficult to say, isn't it? I personally don't expect there to be a crash. We've seen house price appreciation. I'm expecting some falls later in the year. How much and over what period of time, I don't know. But, if we had something like a 10% fall after a 5% rise, 5% down. But you know, in a way, making predictions like this is really difficult and may not have a lot of value, because it's sort of still too early to say. Things are evolving, and we don't know what government and Bank of England response will be to key economic stimulus. So I'm not predicting a house price crash, I have to say. And the main reason for that is housing is a core asset. Now, if you look at the mortgage market, it's the biggest asset class we have in the UK, and we're the biggest in Europe. Housing and housing finance is completely woven into how this economy works, and frankly, there's a political angle to it as well. So I don't expect to see governments or Bank of England let the housing market collapse. I just don't see it, and I hope I'm not wrong there. Do you want me to talk about capital markets?
Yes. So this was Greg Cunnington from Alexander Hall, who wanted to know what the market for securitization of mortgages will look like in the coming weeks and months.
Well, I mean, the market has been incredibly resilient so far. I mean, as lockdown happened, the market's temporarily closed, but in real terms, it wasn't for very long. And those banks actually sponsoring funding programs that use securitization as an exit, by and large, kept those warehousing lines running, and have managed to successfully refinance those into the bond markets. And the deals we've seen, pricing came in throughout these issues from sort of June, July onwards, and significant oversubscription for placing of bonds. I mean, it's been very robust. And I suppose trying to reflect on why. Why is there such an interest in continuing to fund mortgages? And I'd say it's mortgages through originators with a proven capability to originate quality as well as quantity and manage them properly. But there is demand for that origination, and it's undented right now. And I think the answer has to be that if you look at the world at the moment, it's a world of zero interest rates, zero yield, and there's uncertainty everywhere, in every country, and in every asset class. So if you're an investor and you have to put your balance sheet or your investments to work, you have to put it somewhere. And UK mortgages and housing is still a good bet. So, and if you're a regulated entity like a bank, it attracts a low risk weighting. So it is very capital efficient as well. So I think for all those reasons, I am not forecasting a collapse in the housing market. I think we've gone up in value. We'll go down in value. Net will probably be net down a bit, but not a lot. And I see the bond markets behaving themselves well. The securitizations have performed very well. And in fact, over many years in Europe. So well done rating agencies for making sure they got those structures resilient. And I think for good quality assets and originators, there's going to continue to be demand.
Yeah, and if I could just add, I mean, firstly on Landbay, I think the first Luca asked a question about, you know, lenders like ourselves relying on capital markets. We actually have multiple funders. Some of those use capital markets. Actually, some of them use our deposit-taking banks who fund them directly. So a lot of our loans are securitized, and some are securitized just before lockdown, and actually some just after in July as well. And I agree with Tony on the sort of property piece. I don't like making predictions. I generally don't think there'll be a crash either. There may be a bit of a readjustment here or there, but I don't think we're going to see anything too scary on that front. I remember everyone was saying exactly the same after the Brexit referendum, and again, house prices continue to hold up pretty well in that time. I think the other thing that's very important to remember is the Bank of England has reintroduced TFS, Term Funding Scheme, and banks, you know, in normal markets will use securitization markets as well. So suddenly, when the Bank of England opens up the Term Funding Scheme, then actually banks typically stop securitizing as well, and fund managers, investors have to invest in something. And so actually, when you look at mortgage securitizations, buy-to-let securitizations, you know, that the average LTVs on these pools typically are 70% or so, and whoever's the the AAA bonds are typically the sort of top 90% of the stack. So you've got 10% sitting beneath you in the securitization, on then 25%, 25%, 30% of equity in the properties themselves. So actually, there's a lot of protection that sits there for those investors as well. And broadly speaking, if you are a bond investor, and this is obviously trillions of pounds that are sitting in those markets, UK buy-to-let mortgages are probably amongst the lowest risk thing that you invest in. So actually, in a downturn, actually it's possible, likely, that those investors think, well, actually, this is our defensive play. It's not as defensive, obviously, as government bonds, but compared to some of the other things they're doing, they may think, well, actually, we're readjusting their portfolio and stick with that sort of buy-to-let. And one investor said exactly that to me. You know, if the market's hairy, we double down on mortgages. So, and again, as Tony said, the market has held up pretty well. It's not quite at where it was in February, but actually, it's not far away either. And certainly, it's sort of economic. And the fact we've been through the lockdown and recovered very well, even if we do go into another lockdown, I think it will reassure markets that they've been through it once. They know the market will come back, and actually, therefore, I suspect any impact will not be as bad next time as a short term. So I don't think funds will dry up. I think the funding market will be positive. Obviously, as Tony said, things did dry up a little bit in April and May, but then they did come back very quickly.
Right, okay. Got about 5-10 minutes left. We started with news that Boris Johnson had announced new restrictions, and funnily enough, we do have some questions relating to the issues caused by COVID-19 and the outlook for the months ahead. A question from Tony O'Sullivan says the virus will now go and the virus will go and allows a return to normality, and this could take months rather than weeks, according to the experts. How long do you think it will take for the UK to recover from this financially, and what effect do you think it will have on house prices? A question from Ian Balfour from TFC Home Loans. Same subject. Again, once we see valuations being done again and lenders able to offer products with confidence, how long do you think it will take to get back to a normal market? And do you think the government will help to stimulate the market? And finally, a question from Jonathan Smith. Want to ask the panel your views, please, on the pandemic and future house price valuations now that lenders are becoming very cautious on furlough income together with self-employed income. Restrictions and types of occupations, essential and non-essential jobs affected by COVID-19. House prices, again, when we do these sessions, everyone's always focused on house prices, but the effect of the pandemic on the economy has been great. Tony, what are your thoughts on any of those points?
Well, okay, there's a range of things. No one's talking about Brexit, by the way. We got Brexit coming fast, and we got US elections in November, which are likely to have an impact on us. So there's a lot of things going on at the moment. And so Tony O'Sullivan's question, how long is it going to take for us to recover? Answer, a long time. I don't know how long, but it is going to be a long time. So the government is all about trying to keep the economy and markets and individuals safe, but the economy functioning as well. And you can see this stress between Rishi Sunak and colleagues who are just trying to keep economic activity going and defray the cost of revenue that's falling away, versus Matt Hancock and Boris saying, no, we need to do whatever it takes to keep people safe. So there's a lot of political stress between those two, but it is going to take a long time. And if we have to keep going back into lockdowns or partial lockdowns, it'll take longer. In terms of Ian Balfour, he was saying, once we see valuations being done again, how long till we get back to a normal market? Well, we are seeing valuations being done again. Trying to work out what that valuation would be for those done by valuers, quite a difficult job, I would say, because right now it looks great. In November, it might look less great. But we must also think about, we've talked about stamp duties and furlough schemes. The other thing the Bank of England's done is got a £745 billion quantitative easing program in place. That's massive. In terms of expanding our money supply, that's trillions of pounds of the money supply. But at the same time, we've got inflation close to zero. So they're doing what they can to try and stimulate things, but it's not easy. House prices, I think we probably said as much as we can about that, if I'm honest.
Yeah,
John,
and I'll start on the last one really that came from Jonathan. Obviously, he talked about lenders becoming more cautious on furlough income and self-employed income, restrictions on type of occupations. Obviously, we're a buy-to-let lender, so it's hard for us to talk about the residential market. But yes, you have seen most lenders have tightened credit, and you've seen some of the issues around the 90% lenders where they sort of pull out of that market very quickly because they've only got a certain amount that they want to do, and there's a lot of lenders that are in that space. So I think for low deposit mortgages, you've seen a tightening, and likewise again, I expect that is the case with self-employed income. And we talked about payment holidays and our view on it, and likewise furlough income within buy-to-let. I think it is slightly different, but again, in the same way, and this links into Ian in terms of a norm market. We're not quite there yet. I mean, there's pre-lockdown, most lenders would have an 80% product. Now in buy-to-let, specialist lenders anyway, now it's the case where actually very few have an 80% product. So people have tightened criteria, and those 80% products that are out there are more expensive than they were pre-lockdown. The rest of it, actually, we're arguably some of the pricing is a little bit more, particularly on sort of HMOs. But actually, other than that, there is that range of products that are out there within the buy-to-let market. So it's not necessarily a normal market, but actually still a sort of competitive and healthy market. And certainly over the last few weeks, you've seen specialist lenders reduce rates, and competition is definitely returning. And again, valuations, we haven't seen a material number of down valuations any more than we did pre-lockdown, and likewise the amount of time it takes to get a valuation is the same. As I said earlier, I do think there'll be a bit of a issues further down the line in terms of how long it takes for valuations to get turned around, particularly with the stamp duty cliff edge, and if there's a significant number of valuers either self-isolating or struggling to get into properties, etc. And yeah, so that's where we are. I think financially, again, we're going to be paying for this for a while. The economy may bounce back relatively quickly once over the course of 2021, but still there is that sort of burden that is going to sit with us for quite a while, I'm afraid.
So, John, the title of this webinar was "The Buy-to-Let Market, Is It Stronger Than Ever or a False Dawn?" So where would you briefly just put us somewhere in between the two?
Yeah, I know that sounds a very lame answer, doesn't it? I mean, it's certainly not stronger than ever. I mean, they're still obviously on the horizon. That there's obvious risks ahead that sit there. And again, it's not just COVID related, as Tony said. There's Brexit end of the year. There's US election. There's all sorts of things that could cause problems. And we're obviously in an economy that's not by any means booming. And certainly compared to where we were at the beginning of the year, post that election. In January, February, all lenders came back from sort of New Year pretty confident it was going to be a good year, and certainly January, February, the market was very buoyant. So we're not back there, I'm afraid. I don't think it's a false dawn. I always think the buy-to-let market is very resilient. But yeah, I think we're not totally out of the woods yet, as we've seen with what the government is doing in terms of change restriction. But I am still, where would you put me now? I'm still sort of mildly optimistic in terms of where we put it. So while we're not best ever, I think we're certainly in a far better place than any of us probably expected in May.
Well, I think a lot of us can live with mildly optimistic, so we'll finish on that positive note. So that does bring us to the end of this special Mortgage Introducer webinar in association with Landbay. Thank you to both John and Tony, and thank you at home for watching. You can watch this broadcast again via various social media and also on the Mortgage Introducer website, which we found at www.mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, stay alert and stay safe.